You guys good? Ready?
We're good to go.
Yeah. All right. Hello, everyone, and welcome to the show. My name is Chris Alaimo.
And I'm Ben Gassaway. Together, we are the Amateur Investors.
This podcast is our open source journal of everything we learn about investing and wealth management.
We're here to explore the key concepts, market dynamics, and investing strategies that will assist you on the path toward financial independence and financial literacy. Our mission is to build us up from amateurs to experts.
All suggestions are our own, and we recommend that you do your own research before taking any investment advice. See you in this week's episode. We hope you enjoy it.
Hey everyone, welcome to the show. Our guest today is the founder and general partner at Good AI Capital, a venture capital firm based in the Bay Area. He is an expert at early growth companies in the fintech, healthcare, and B2B SaaS sectors that leverage AI technology in their operations. So everyone, please welcome Mr. Darwin Ling. Mr. Ling, thank you so much for being here.
Hey, thanks, Chris, Ben, for inviting me. It's really, I'm really excited to be joining you guys and the audiences today. So really look forward to speaking to you all today.
We're honored to have you. Thanks for coming on.
Yeah, thank you. I always love to hear sort of the time traveler's narrative of how someone goes through their career. So give us the progression from when you were in college as a computer science major at Purdue to how you're now the founder of your own venture capital firm. I feel like when you look at someone's LinkedIn profile, it feels like you go from A to B with a straight line step, but I'm sure that it was more of maybe a sine curve and climbing up a mountain. So we'd love to hear about sort of that progression in your career.
Yeah, of course. So, well, you use the term time machine, so I'm definitely an old guy, much older than you guys.
Barely.
I'm originally from Hong Kong. I'm a foreign student immigrant from Hong Kong, and I came to US in 1985, the mid 80s, to basically pursue a college education. I get my both engineering and computer science degree from Purdue. For those of you who are not familiar with Purdue, is a great engineering school based in the Midwest in Indiana. So I came to this country, the first place I came is Purdue. So I don't know how many of you have been to Hong Kong, which is one of the city that is full of skyscrapers, even back in the 80s and 90s. So going to Midwest to a sort of rural town, it's really like a stark contrast, and it gives me a lot of great perspectives. Really, as they say, other than the engineering, the education that I can pursue, but really give me a great perspectives. How to operate, what life perspectives are, how the outlook of everything. So, and by the way, I also met my wife at school. Also, my wife also went to Purdue, and this is how we met. Have a lot of great friendships. The professors, everybody has been my great mentors. People welcome us. Like I mentioned, it's not about the education that we receive. It's really the people, the warmth, and how we can appreciate, the opportunity and the possibility in the U.S. itself. So I think that's actually kind of shaped my career and how we get into the technology, and also ultimately becoming an entrepreneur and have some of the great successes. I owe it to my education and also to my time at Purdue. So kind of fast forward, so I'm an entrepreneur and have several exits. By exits, some of the company is actually, I was a founder of some early stage technology companies. They were able to either get acquired or get IPO and all that. So basically it has the fortune to be in some of the greatest teams at the early stage. how to build some of the greatest products that, have a lot of impact towards, not just the customers we serve, but the sort of the society and the community also that, surround us. So I'm really proud and grateful that I had the opportunity. So, my latest startup, I actually launched a startup in 2015. We focus on selling software. It's a mobile app that sells to sales professionals. Basically, we use AI, artificial intelligences, to how to improve sales productivity. So some of the marquee customer names I'm sure you heard of is General Electric, Home Depot, as well as Danaher, which is a Fortune 500 medical device company. So we can see how technology can really improve the automation, the lot of different aspects of a busy professional sales when they're on the go. We give them the insights of what they need to use in order to reach their customers. So seeing the impact is really gratifying, as well as very great, enduring to us here. So in 2018, 17, we sold the company. And this is the time we kind of think about, what's next of my career. So I have achieved the successes, the career successes. Then kind of like, rewind back a little bit. So as an entrepreneur, I actually started doing a lot of angel investments. So basically that's the part will be a good leeway to some of the later discussions here. So angel investment basically is you write a check, you invest in some of the startups. These startups, a lot of them in the early stage, they do not have a lot of products, lack of even revenues, of course. So one of the company that I did early on, investment is called SoFi. That company in 2013. So I invested in the company at that point. It was like what they call a Series A. It was worth about 100 million valuation. So fast forward, the company currently is filing an IPO to the public market with an $8.6 billion. So you can actually see the multiple increases with a 50x return. Actually, I haven't done the calculation for 70, 80, the return on the money that we invested in. So I was really proud of that company. So why do I want to mention that company? Other than the financial success, is really part of it is they want to use technology to really improve the financial accessibility for their customers. They start out with student loan, and then they proceed to, support the mortgages. So basically, they want to create a lifetime journey, support the lifetime journey of the individuals by providing them tools. And kind of like, their mission that they call the mission is to how to really, empower their members to support their companies, to support their members to achieve financial goals. And that's actually what impressed me quite a bit. And then, of course, they blend AI or technology to do their credit scoring and all that. So in that case, that successes kind of inspire me. They said, look, if I want to do something, whether it's launching a new company or, something that, it has to make an impact. It has to be impactful. We kind of figure out the sort of like a secret sauce, if you will, where, how do you kind of achieve that outsize, the outlier, the profitability or the successes. And we kind of figure out, yes, that's it. It's really the mission, the values of the company. And that kind of just draw me say, with that, that kind of leads me say, and this is what I want to do to launch a venture fund that adheres to that thesis. And at the same time, as the entrepreneur myself, so I want to really take this opportunity to mentor the next generation of entrepreneurs, so that they can have not only the capital, which is the investment, but also the know-how, the network, the operational background that it needs in order to succeed. And this is what we do, and this is why it kind of led me into the whole launching this venture fund.
Yeah. So a lot of really good points there. Thank you, Mr. Ling. I guess expanding on that more so, I know we talked last week in prepping for this call that talking about SoFi, and I actually downloaded the app last week and I checked it out. And in light of everything that's going on this week with the GameStop against Robinhood, against the hedge funds, I actually really like the app. I still need to investigate more into it, but it had a nice, kind of user interface. I really liked the way that it looked. It almost had like a social media aspect to it. I was fortunate that I had moved a lot of my holdings out of Robinhood over last summer and early this year before actually any of this went down. But yeah, no, I was kind of looking for a new platform to move to, just because I heard from you and other people saying how bad Robinhood was. So that kind of sparked my curiosity. And then in light of everything that happened this week, I guess you guys were proving right what I did. So I know Ben and I are both looking for new platforms. So it's definitely something I'll investigate going forward. So I guess moving on to our next question. I know folks in our audience may not be familiar with venture capitalism. So can you explain some of like basically the business structure, the reporting structure, what the company does, and basically what your incentives are or how you operate as a business? That'd be great.
Absolutely. Yeah. So I think I kind of alluded at that earlier. So basically venture capital is what we call is one of the investment focus within an area called private equity. So private equity, the PE, what most people refer to is really just investing in private assets. And what that means is that there's no public market that is usually available. So what that means is that liquidity is an issue, or not an issue. It's not, you don't have the liquidity as readily available in, say, a stock market, right? So, and basically, real estate is a really good example. So you cannot go in and buy and sell a house on a stock market, just like you did in, a NASDAQ stocks, right? So you can buy and sell a house, but it takes some time. You need to find, the right places and so forth and so on, right? So in a way, that kind of lends to also some of these venture capital or venture-backed startups. So, even within, the private companies, you're talking about some of the potentially later stage companies where, it could be in a factory, the company is not like, they're not a startup. They have solid revenue, but they're not public yet. So there's actually a lot of good tractions potentially that you can use. But for a lot of these VC-backed companies or venture-backed companies, they're really early stage in a sense that, this just could be where, it's just 2 founders or 3 founders who have a PowerPoint. They may not have a product, and let alone revenue, of course, because they haven't built a product yet. So it's really at the early stage. So what that means is that there's a lot of risk. In that case where, how do we, gauge whether this company could be, potentially a great success, right? And that's where sort of like our network, our industry know-how, and also as well as our background as an entrepreneur itself, we know we're taking a lot of risks. But but we have sort of like a blue book, if you will, where there's certain group of characteristics of founders that we need to look for. And in our case, I mentioned it briefly, is with really our what we call the mission-driven values. You talk about our name is called Good AI, so but that means actually it's doing good, doing well. So the founders that we invest in also need to adhere to those values, and that's actually kind of create a sort of a guidance for us to say what type of companies that we need to invest in. So of course, at that stage of this, a lot of these startups, you don't have all this like, the financial regulation that you typically required than, in the publicly traded stocks. If you look at the balance sheet, balance sheet is pretty much nothing. So, so I guess that's a part where, you still need to have a financial system to track it, and more so on top, like from an investor point of view, there's things where you need to manage their kind of like the stock allocations, some of the stuff that need to kind of have create incentive for founders initiatives. What are the kind of potential ownership between the investors and all that? So these are the things that also exist in a publicly traded company, but they become more important for us early stage startup, because those are the things that you need to have a nice governance structure. We still need to have a incorporated, it has to have the right governance, who's the board, one of the board, who is served on the board and all that. So those things has to be in place as well. So that's kind of like, a high level description between the early stage companies as well as publicly traded companies here.
Yeah. I want to go into some of the mechanics of what an IPO is, but before that, Chris and I are we really enjoy using like the discount cash flow model to build out sort of our valuations for companies on, in the public sector. It's pretty easy when you have a company that is, 10, 15, 30 years of financial data to sort of, create a valuation. I'm sure with the venture capital and the private equity space, there's a bit of extrapolation for numbers that are based on projections and estimates. How do you build both confidence and a robust model with limited data? Is that just that the time scale gets shorter and you're working with revenues and you kind of just guesstimate the free cash flows based on some inputs? What are some of those variables that you're looking at for sort of a company? Let's say you're looking at the past 3 years of a company that's prepared to go IPO. How do you take a look at some of those little snapshots of data and build a model around sort of a short time scale? I'd love to hear your process.
So I think, from a lot of tech companies, we have this concept called, like I mentioned, a lot of these companies, they may not even have the product, right? So at this stage, typically the typical metrics that we usually look at is a couple of things, what we call product market fit. And it's a metric that is not associated with the financials or basically the cash position or anything like that. So that talking about like, user adoptions, how many people are using it, how frequently they're using the product, and, kind of give you a sense of, the current status of the company and the product. And what we're looking at very keenly is actually the growth metrics. So it doesn't matter if you have like only 5 people that are using it right now, right? Or 5 users, customers. But let's say fast forward let's say past 3 years, we see a growth pattern like 1,000%, 5,000%. The sort of the metric what we call the growth trajectory. That really gives you a really good snapshot of say, yeah, there's something there. And of course, it will be a bonus if they have, earning revenue during those time. So we kind of, but, that's sort of really, that was always the secondary, metrics that we looked at. So, the DCF, model applies more to like what you say, the more mature company or more mature industry, because, sort of the cash projection or the revenue projection is more predictable. They're focusing on, the market expansion. They know that they can give you, say, in the next year, we're targeting expanding their customers from 5 to say 10. And here's the sort of like the growth in the pie, if you will. That's all good, but that doesn't typically mostly apply to some of the companies that we looked at. And, like I mentioned, some of them don't even have customers or let alone cash flow in those cases. So, yeah.
No, that is a great overview.
Yeah.
That's a great point, right? Like the discount cash flow is not going to, despite the ads that you'll see on Facebook, the DCF is not going to find you the next Amazon for $3. I feel like you do have to take a little bit of risk and dig in intimately to understand a little bit more.
So I want to interject. So one thing though, actually, so we do look at sometimes. So we also invest in a lot in biotech healthcare companies. Yeah. So typically, even though they're a little early stage, but in the sense that the way we looked at is that they have to what we create, look at a pipeline. So by pipeline meaning, is that what customers they're looking at. And typically, they work with the pharmaceutical companies, the drug company. They use AI to do drug development, for example, right? They're not, these startups that we invest in, they are not the companies that are, say, look, they're going to create the drug itself. However, they provide the tools and the platform to support a pharmaceutical company in order to, reach their milestones, whatever they've laid out. So what that does is actually turn out to see a lot of these DCF models turn out to be applicable, because, the DCF itself is actually applicable to say, these are the milestones that they have set. And actually, when they each reach the milestones, they have like a revenue streams that comes in as part of that, success. So in a way, because, DCF is say, look, in this year, I'm going to project my revenue is X amount. And then the next year will be, this year 1 million, next year 2 million. So you kind of do this, back calculation to create this DCF, right? And that's easy. And that actually can be applied to some of those companies that we invest in, because that's exactly the revenue stream they're getting in, although they're not actually creating the product during that time, but they are actually the contracted revenue that they will receive from some of these large pharma that they do business with. And actually that turned out to be quite applicable in terms of how we do the valuation of the company when we invest in some of these companies, because they say these are the contracts that they have lined up. And that's part of our due diligence also. So when we invest in company, valuation is a very important metrics or important kind of like outcome that we need to look for, because this is part of the negotiation that we need to negotiate with the founders. Like, okay, if I put $1 million, I want to own 30% of the company. That's basically what that means, is that the company is worth 3 million, for example.
Yeah, it's like we see it on Shark Tank all the time is a good example when
exactly. But the founders say, look, my company is worth 10 times more, and that's where the negotiation comes in, right?
Yep.
And you say 10 times more, I want this. So what is your data? How do you justify that, right?
Yep.
That's the negotiation that we need to come in.
Yeah, I think that's a good segue actually into sort of discussing the mechanics of like the IPO. You mentioned that your firm's portfolio has SoFi as a holding, and when we were doing some research, they're going to be going public through SPAC. Could you give our audience first an outline of really what an IPO is? I think it's easy to sort of grasp onto headlines and then not dig in deeper to understand like what is the purpose of an IPO, how does that work, and then secondly, as a secondary follow-up, what makes SPAC different from a traditional roadshow or direct listing?
Yeah,
of course.
To give people a heads up too, SPAC stands for Special Purpose Acquisition Company. So
thank you. I'm using acronyms again.
Yep, no problem. Sorry to cut you off there, Mr. Ling.
No worry. Just call me Darwin from now on. No need to call me Mr. Ling.
Fair enough.
I'd be honored.
Appreciate it.
No problem.
So so IPO stands for initial public offering. And, we talked about some of the investment, early stage investment into private companies, right? So, when you invest $1 there, your worth or the value is on paper, right? So there is no market that says, at least not as a very liquid market where, look, I want to buy your SoFi stock. You put the $1 in it, I want to buy it back, right? For $1. There's no market, right? So in a way, it's all paper money. So for an IPO, so one of the main purposes is an exit for the company. So the company has been working for so long, for so hard. Investors put in their money, the founders put in their sweat and equity, sweat and blood into the company, and then they achieve the success. Now the stock of the company is finally worth something. An IPO basically is an exit event that says, look, here's my stock, here's the value of my stock, and people are willing to pay for this now because there's a public market, people are willing to buy and sell. So this is what we call a liquidity event, if you will, or exit event. Basically, now, everybody accomplished the milestones, and you can actually have a financial reward as part of that, event. So, this is why. So some of the stocks that went IPO, people usually stand up in the podium, they ring the bell. It's like, because it's a huge accomplishment. You see that on CNBC quite a few people ringing the bell and all that, right? So that's that, right? So one thing that also people may not be aware, an IPO is also a financing event. And by that meaning, actually, they want to use this opportunity to raise more capital for the company. So, and remember what I said, earlier, say every time when you invest in a company, valuation of the company is matter, because hopefully, a company, when they go from this early stage round to all the way to IPO, each round they will go through a number of financing rounds or events. And, you can raise what they call Series A, Series B, Series C, and finally the IPO. So IPO is part of the financing event in a way. So you culminate it to a stage where, here's my company's worth, because you need to tell the market, how much is your company worth, right? And from there, you actually need to typically allocate or, sell more stocks of your company as part of that event. And by selling those events, by selling those stocks, so that's the part where you get, you basically do the calculation. This is what my company is worth, and what is the equity, ownership for the entire company. And so you have to disclose that. So basically, a lot of people are not aware that the fact that it's just people getting rich on IPO, but there's also the fact that, people are using this opportunity to raise more capital. So interestingly enough is there's also another kind of you guys mentioned SPAC and also direct listing, right? So there's also what I just described to you is a more traditional way of IPO. And so of course, there's another kind of listing effort. It's called direct listing. So the direct listing is a little bit different than the traditional IPO in that where, basically the companies, they all, it's a more of a liquidity event. And by that, actually, they're still seeking capital, but actually the way is they're not selling, they're not allocating more stocks, if you will, to sell to the public market. So basically they use the existing pool, and then some of the product from the management team or wherever that reserve in the stock, they will actually sell the existing portion of the stocks within the company through this direct listing. So basically what that means is that you have a less opportunity, if you will, to kind of find your, or actually you have a more kind of transparency to how you set up the price for that. And some of the company that we talk about directly, the two very prominent one is that Spotify went through a direct listing, and Slack is another company that went through a direct listing. Slack. Yeah, absolutely. So and then I guess thirdly for SPAC itself. SPAC is sort of like a instrument that become popular in the last couple of years. So SPAC actually is quite interesting, is that where, so we talk about how typical company using IPO to raise capital, right? So SPAC is sort of like the reverse. So some SPAC is usually a shell company. It's usually led by very, well-known investors. They said, I have a SPAC. The SPAC is going to invest in some companies, and that's sort of my, promise. And I want to raise $5 billion through this SPAC. And then they actually need to go through also sort of like a listing process or IPO process in a way. So the SPAC itself is trading in the stock market, and they raise the capital, and then they actually have that kind of sitting, at a shell company. So the SPAC, then what they do is that they look for companies to invest with the capital they have raised. So the difference between a direct IPO or versus a SPAC is that, so IPO are companies looking for capital or money. SPAC is like money looking for company to invest in. So that's a little bit different. And for that, I think people may ask, like, why so special, right? So couple of things that come to mind is that really it's an easier process. Going IPO is actually quite expensive. There's all this sort of regulation and all that, that need to be involved. And basically it's a speedier process. You don't have to go through, all this different roadshow and all that, because the money is already there, right? So it's just a matter of how you kind of do, that process. So in a way, it has the advantage. You can actually help companies to go public via this SPAC vehicle, where, much more faster. And also thirdly, I want to talk about the pricing is actually a little bit more under control. I think one of the things that we talk about when IPO, one thing that I didn't mention is that typically in a traditional IPO, you will actually have what we call underwriter to facilitate the entire process. The underwriter are the Goldman Sachs of the world, the investment banker. So what they do is that, look, let's say, a company called, Uber, for example, right? So they want to go IPO, they will go talk to Goldman Sachs. Goldman Sachs, I want to sell, 10 million of this shares of this Uber. And, please go find the buyer, if you will. And by these buyers are not the buyers that you and me, the retail investor. They say, look, we want to look for the institutions where you need to buy a big chunk of this stocks here. And they're willing to pay for a certain price. There's a price discovery process where, the underwriter need to figure out, okay, do I have enough people who are willing to pay $5 for each shares of the Uber that is allocating? And remember how we talk about, the stock price will actually determine the valuation of the company, right? And the valuation at the end of the day is really what determines, is my company worth this amount of dollar and all that, right? So that's a price discovery process that is facilitated by, by this underwriter. And oftentimes you might hear it, time to time when, listen to the show, is like, they might not have all this, the right price figure out. They always have the word where, Airbnb just went IPO, they set the price for $60, but they jumped to like $120 today or for whatever.
146, right? It was crazy.
Something like that, right?
Yeah.
So the first day pop. So what that first day pop, it sounds great, but actually it turns out to be, they leave money on the table. What that means is that they could have asked for $140, but they didn't. They only asked for $60. So that's the part where, then who's benefiting, right? So it's not the founding company, because they already sell the stocks and then, at the $60. But, it's really up to the public market to jack up the price 140. So basically people are willing to pay $140 for the Uber stock. I mean, for the Airbnb stock, for example.
Yeah.
But yet they're not benefiting the company who sell that stock. And it's actually benefiting the subsequent trader, if you will, or the people who bought it at $60 because there's a block of financial institutions that buy the $60 stock, $60 Airbnb stock. But now, immediately they trade it, say my $60 is worth $140 now, right? So they make a profit out of that, right? So that's a part where we typically call that, you leave money on the table. But so as a, so there's what we call inefficiency, if you will, right? Ultimately, you want to make sure that, everybody, the rightful owner, if you will, should get that money, get that capital, get that work, right? So that's the part where there's some nuances, in all this IPO processes. And so that's kind of like, hopefully that gives you kind of a snapshot of, how the whole IPO spectrums work.
Yeah, definitely. And Airbnb was the one case study I wanted to bring up. So you brought it up without me even saying anything. So that was perfect. This is really a case study for markets going forward for these tech companies. I mean, Airbnb was one of the most anticipated IPOs for the past several years. And the fact that they left billions of dollars on the table, I think that there will be tremendous scrutiny going forward. And from what you said, I think, I would love to know really quick before we shift gears is, where do you think going forward, this sort of shifts the paradigm of how companies prefer to go public? is SPAC the future of IPO? What leaves the company with the most autonomy in their pricing structure? Because obviously, when you miss 115% of your real valuation, that's pretty unfortunate if you're trying to raise capital.
Yeah, so I think, in a way, I think the traditional IPO process will still stays. SPAC is just an opportunistic, for a lot of these companies. To be frank, I think, we have some insider information about SoFi itself. So they actually was trying to go IPO a couple of years back, but instead they have to seek the private market. They actually raised another round, a couple of years back from private investors. So part of the challenge is really going IPO is not easy, right? So, but if you can overcome the hurdles, you really give you a lot of great visibilities, right? So everybody just talking about, on CNBC or your, financial news network, everybody just went public, and then that create demand in a way where, so yes, you lose some money initially in the IPO process, but there's such a momentum, or the word we call publicity, right? It's a marketing, in a way, is how do you kind of manage the supply and demand, right? So if you prop up like, the marketing, Airbnb just do this and all that, they leave $120, there'll be more people who are willing to say, oh, I might be missing the boat, so I want to buy the stocks now, right? So that's a part where a typical SPAC or direct listing may not have that kind of drive, if you will. And usually that's, as you and I know that, stock market, especially the tech stocks, are very volatile. It can go up, like GameStop, this week, it can go up 400%, but it come down, immediately. So how do you kind of manage that expectations, right, for traditional? And I think in a way, overall, I think the IPO process is still very valid and is very good. Ultimately, you still want to be, listed as an Apple, Amazon, get into S&P 500, to be on the kind of that, very prestigious indexes. If you can get into S&P 500, then I think that you're set, right? So that's very important. And so that's sort of like the one question. So SPAC definitely has its place, and I think it's really, really helping a lot of these companies to go through that process quickly. And ultimately, I mean, even if SoFi go to IPO through SPAC, I mean, now they're in NASDAQ or, New York Stock Exchange now, and that is it, So if they can speed up that process, and then hopefully with that, they can still kind of capture the momentum, afterwards. It definitely has this great place. And I don't imagine every company will go through a SPAC. And I don't imagine everybody is going to go through a, even a direct listing, because, there's obviously some drawbacks in that process. There's a lack of hype, or the sort of like the momentum marketing drive, if you will. Hopefully that answer kind of like, the kind of laid
No, it's
out
perfect. It's nice to have options.
Yeah. Yeah, so thanks for taking us through going through the IPO process and what that entails. I know Ben and I are not accredited investors and or venture capitalists, or have a large amount of capital that we can employ to get into those deals right now, maybe in the future one day. But I guess, how would you recommend?
But you can invest in it.
Sounds good. I do know you now, so I can take advantage of my connections now. So maybe I'll take you up on that. But I guess for the amateur investors, or the retail investors as we call them, how do you help them, or how would you recommend that they evaluate companies post IPO? So as they're listed, I know personally for myself, we talked about Airbnb. I think DoorDash was also IPO'd in the same week, and I just think the evaluations personally are ridiculous for what they were. I know, just comparing market caps, there was a joke that like FedEx, I forget what their market cap was, but DoorDash only delivers food, and they're listed above FedEx, which delivers everything, which I thought was hilarious in terms of just, the scale of what they can do. DoorDash is only food, FedEx is everything, and yet DoorDash is valuated higher than them. So how would you, mitigate risk, or how would you advise someone to evaluate a company as they're going IPO, like we said, with lack of data and revenue streams and stuff and such?
Yeah, so I think, like everybody said, I think even getting in an IPO or hot IPO is definitely quite a risky game. So, even, of course, it's a big payday for the early stage investors because I only invest like, SoFi at that valuation now is like, 60 times now. So losing a valuation a couple million, to me, it's not a big deal.
You won't lose sleep over that.
Yeah. But, the whole point is for retail investors. So first, actually, let me kind of jump back a little bit. There is an opportunity for some of even the retail investors to get into the IPO process. So, some of the, I don't know if you heard of this, there's a market called secondary market.
Okay.
So the secondary market is like something usually is operated by sort of like a marketplace. They're not like the NASDAQ or not, but they're actually companies. What they do, they can actually go out and, kind of get some of the hot, companies that are going IPO. But before that, they've got some allocation that's that, it's not a huge deal. They're not like getting, so let's say they're selling, Robinhood, SoFi, even when Airbnb before going public, there's a market for that. And there's actually usually these stocks sold by maybe some of the founding members of the company, the founders, early stage employees. Remember these guys, they hold the stocks, but there's no liquid event for these stocks, right? So, and sometimes they need money, so that's a time where they're willing to part their stocks as part of that process. And that's some of these markets will come into play. And you don't need like, a lot of money in order to buy a share of Airbnb before they go IPO. So they offer that. So the pricing are usually where maybe based on their last round of valuation or whatnot. So there's the opportunity. So that's kind of, I want to make aware, there's actually a number of these, market, if you will, that offer the secondaries. So that's number one, right? So number two is where, let's say the company Airbnb just go IPO. The question is, should I buy Airbnb, right? So that's a very, of course, a subjective question, or, you have subjective answer to do this. It's really, I think, to the point where, are you willing to bear the risk other than the hype itself, right? So hype can go up and go down, as we've seen this week, right? So GameStop can go 400%, but they come down like crazy, right? So that's a part where kind of caution all investors. You can do your homework. But like I said, all that valuation work, DCF model may not apply to Airbnb, right? And that's the part where you say, do you know the product? Do you know the company? Do you know the product well? And do you like the company? That's actually sort of like, very more on the, emotional side of things. So the technical side of things that, of course, you can see, if in the case of Airbnb, the growth trajectory is really phenomenal. I think I really like Airbnb in the sense that because once the pandemic broke out, everybody's saying the whole travel industry is going to be collapsed. And Airbnb, of course, is on the center of that. Nobody's going to try to travel anymore. All the, no renting and it's going to take place. And they did go through a tough time, the company Airbnb. But, what amazes me is that how they bounce back, actually. So they were going to IPO in 2020, but, they have a huge layoff, of course, in the summer in 2020, or layoff, not huge. But part of it is really how they bounce back. And, seeing Brian Chesky of how they say, has an empathetic kind of like, view as that, look, yes, sorry, Miss Airbnbers, leaving the company, but here's how we want to, help the company, help you to continue to find your next employment. We're going to continue with severance pay and all. He wrote a very lengthy kind of like, post to outline that purpose. And that's a stark contrast of some of the companies that we see where you need to have like great leaders to kind of lead through the company in good times as well as in crisis, right? And that's actually sort of like a non-quantitative metrics that we looked at also. We looked at the quality of the leading team. If these guys are actually being to carry it through, you're no longer measuring what is the DCF, the revenue and all that. And, it's really that how you navigate those challenges. And then actually they come through, Airbnb, the stock is, like I said, they start off $60 and now it's $140 or whatever. They came through successfully. And that's a part, even though they don't have the revenue projection, but how we see it is, they navigate a crisis. And I have confidence in the management team that these guys are going to be even navigating further. And that's where the valuation that comes in as FedEx in a way is a little bit boring. Well, I won't say boring. It's just that, you have a more kind of predictable outcome.
Yeah.
And whereas Airbnb is like, the opportunity is huge, right? I mean, you can look at it that way. Now, potentially the economy is opening up now. So the question is that, man, that's going to be like, you see that growth metrics, even though at the downtime, they still kind of maintain the growth, how their, renting rate and all that stuff. Then it's like once the economy is open, I think, that's the part where, they're going to take off, right? And that's where, again, it's a very kind of non-quantitative way of evaluating a company, but that's actually a very good way. And if you think that you can still believe in going through that trajectory, this is the time you buy it. I think, if it is $140, so far, I think this company is worth 10 times more, right? So, and that's how you feel. It's not like really what everybody should say, right? And I would say, do your homework, still look at the S1, all that, but all that, will help you kind of gauge your, assessment, if you will. At the end, you always need to bear in mind that putting that $1 to buy that Airbnb, you might lose it all. You have to kind of keep that in mind, right? You're not buying a more reliable company like Apple, because you don't think Apple will not disappear tomorrow, but Airbnb could be disappearing tomorrow, right? So you need to kind of bear that risk also, and that's how you kind of manage it. And then we can talk about how do you manage the risk. Is that you actually need to construct a portfolio as opposed to say bet all my savings on Airbnb. That is the wrong thing to do also, right?
Yes.
So I pause here and then I let you guys, continue.
No, that was perfect, Darwin. Thank you so much for sort of the insights on that. First, I think we're probably going to get started wrapping up pretty soon, but I just really want to thank you for this conversation. I think these are some really, really unique insights that Chris and I at this point in time know nothing about. So this was so valuable for us. And I know the folks listening in are really going to enjoy this conversation. Mm-hmm. One question. So I have an idea maybe for a future episode. If you enjoyed this and had fun, I would love to talk about maybe some of those qualitative aspects of evaluating a business. It's easy to assign numbers and growth metrics, but looking at the management and taking out, like extrapolating insights from the 10K, the earnings calls, I would love to hear your insights. Maybe in a future date, that could be a good focus point. One question that we're trying to ask, and I'll hand it off to Chris after this as well. But one question I always like to ask our guests that come on the show is, what was the biggest investing mistake of your life? And what were some of the key takeaways from that? And how has it sort of shaped your perspectives today?
Well, I would say, it's not a mistake per se. I actually, I typically when, some of the VCs or venture investors, they only talk about their success. But out of one success, there are probably 10 failures. They don't want to talk about because, nobody knows the name, and nobody cares, and all that. So one of the company that I first invested in actually is a game company. Is one of these startup with two people that are really, they're also immigrants. They're from Vietnam, actually. I met them through a accelerator. It's one of these gaming company, and I'm starting to just doing my angel investment. So I put some money in, not to do a whole lot of due diligence. I just said, I like them. I like the game. And that was it. I just like, okay, here's a check here. To fast forward, turn out that company failed. They have to close down and everything. But what I was actually alluded to is actually letting me to become a platform of learning, if you will, right? So this is part, all that stuff I told you about valuation, all that management team, and all this growth metrics. I know nothing about back then when I first invested in the company. But because I invest in this company, seeing how it failed and what it kind of like led to, give me the kind of learnings that I need to say for my next one, here's the set of metrics that I need to look at, other than the fact that you like the people, you like the team, right? So that's the part where you grow as we kind of, mature during that process. And again, I think this is only one, there's a couple other ones that are kind of similar, but that again is really, I think, don't think of it as a one single failure point as the entire failure in your life, if you will, right? So every single thing will create an opportunity for you to grow both, professionally as well as personally. That's just life, things in life that happen. There's a great saying that says, you win some, you lose some, right? You can't win all the time, right? And hopefully you don't lose all the time, right? Too. So that's a part that, I think that will be very important. And to fast forward that company, actually, the founders, so their company got acquired and, that got folded into another kind of gaming company. And at that point, the founder introduced me to the, sort of the acquirer of the gaming company, and then turned out to be a sort of like that company I invest in. The company is also a gaming company, but it's more focused on the infrastructure. That turned out to be a real successful investment because I also invest in company. That company, by the way, is called Playco, Playco. So it's a infrastructure for mobile games. So at that point, I invest in their actually even seed and Series A with a valuation of 20 million or 30 million, something like that. So fast forward, the company become another what we call unicorn. The company is also $1 billion company now.
Wow,
that's a great return.
So I have another 40 bags of return. So I know, because of that, my initial engagement with the failed startup, if you will, that led me to be greater things, right? So that's the part where I kind of tend to look at is like, can you learn something from it? And it's always leading to greater things that you don't know, but always keep an open mind, of things you want to try, you want to learn. Don't get sucked up by, say, or the hype. Okay, now, I need to invest in GameStop and I need to go, short this and all that, right? In a way, think of what your goals are. I mean, if you want to just say, look, I want to have being more financially savvy so that I can plan for my, a great success, investment. And I really like the company, then yeah, do your homework, do your investment. Again, you can fail, but at the same time, prepared for like greater things afterwards, right? That's sort of like, the attitude that everybody should be thinking of.
Yeah, I always like to frame the mindset as, your losses are just the tuition of your financial education. You just have to frame the mindset properly.
Yeah, definitely.
So make sure that you don't want to do a bet, sort of like a sort of betting kind of attitude. So you could go to Vegas and then this is, all right, here's my minute, I'm going to do this, and all that, right? And people tend to think of like stock trading or, investments kind of like that. Yeah, I know this company is going to go crazy. I'm going to bet all my savings on this. So that is a very wrong attitude. And I hope everybody, in the audience should be learning that should not be, what we should do. And actually think of a financial goal that you want to achieve, based on your investment, based on your paying off your student debt. I'm sure, that will be very important. Don't just say, yeah, student debt, I don't care. Let me just, bet all my money into, stock or something, right? Let's make sure you pay off your student loan first before you go crazy on investing. So
definitely. Yeah. So, I mean, perfect point. I mean, we hope everyone's winning more than they're losing, but I know one of my great coaches that I had in my swimming career always said you learn way more from your losses than you do from your wins. And I think that applies to literally anything, investing, sports, whatever you want to say. So going on the topic of learning, I know I love to ask our guests that come on, what are your best ways of learning? I know historically people use books, but we'll recommend, even if you recommend YouTube channels, Twitter can be a crazy place for learning as well, or, any books. What would you recommend is your favorite place to go to learning about investments?
So, I subscribe to a lot of these, I would say, CNBC and all that. But that's what usually for, you can get hooked in front of the TV 24/7, right? Though that's the part where it can drive you crazy sometimes. You cannot, we have a life that we cannot spend looking at the market, every single day, right? So I think, but occasionally they have a lot of great aspects coming out from those financial networks, and I think that's good. So because we do like VC, so we do a lot of materials in the private markets, where, for venture business, if you will. So that's a part where you can subscribe to TechCrunch and all that. It's a lot of different information. And also, I think, just a lot of podcasts and all that, and now it's coming through now. I mean, you guys obviously, doing a good job in, do that education. And actually, do a plug on SoFi. And then one of the reasons SoFi actually that I like so much, other than, I think I talked about the app itself. I mean, Chris, you talk about the app itself is easy to use, it has a nice experiences. When in actually, what it focuses on, it's not about just say, hey, I can buy this Bitcoin at this, their aim is to do financial education. So in there, they actually have a lot of webinar, video materials that say, look, how do I pay off my student loan? Okay. How do I want to buy my first house? What should I pay attention to, right? And how do I finance it? So they actually have a lot of those materials that are found in the website, also as well as the app. And of course, they will provide the educational platform also. Let's say you want to do option trading. What is that? So they give you that, kind of like tools, if you will, as opposed to some other company, I don't want to name names, where they just here's a big button, buy this $100 options on GameStop, So that's the part where, that's a very risky kind of motivation. But these guys they set out to be really to help, the millennials or people that in financial need to be successful. And I think that's actually is a lot. And of course, they actually have gamification where, they have a leaderboard, the CEO of SoFi, this is a portfolio of my stocks here. I'm up 50% now. And what is yours? So that's kind of have created a little bit challenge. But that's for fun, it's not like you don't have to buy all the stocks just to compete with the certain individuals. It just motivate you a little bit more to learn from their strategies, right? So the part where, why do you want to buy GameStop, right? Then that's kind of trigger you where the learnings come from. It's supposed to go to a website or material, read the materials, and actually just turn that into action, turn it into fun experiences. And I thought actually I want to mention that.
No, it's perfect. And I'll be sure to link SoFi in our show notes for sure. Darwin, thank you so much for this conversation. Chris and I had a blast. I hope that you had fun too. But before we let you go, we're definitely going to link to SoFi, but I want to hand off to you if folks want to learn a little bit more about you, maybe a website to your venture capital firm or your own Twitter, whatever you want to plug here. I leave the floor to you.
Yeah, so I mean, our firm is called Good AI Capitals. Our website is goodai.capital. So I want to highlight the fact that the capital is also part of the domain name, and then there's by design. So go to goodai.capital, check out our portfolio, check out our investment thesis. Follow me on Twitter. Follow us on LinkedIn. So we're available there.
Perfect. We'll be sure to link it in the show notes and share it with our network. So absolutely. Darwin, thank you so much for everything.
Thank you, Darwin. Thank you so much.
Sure. All right. Take care.
We'll see you guys next week.